Today we're doing a deep dive into the work of Bud Labitan. And and it looks like he's written a lot.
Yeah, he's written a bunch of books.
Yeah.
I think this one we're going to focus on today is Bud Labitan's inflation views.
Oh, yeah.
Yeah.
That's the one that caught my eye, too. And from what I understand, it seems like he's really focused on
he's got this
Warren Buffett.
He's got this really interesting take on how Warren Buffett navigated the economic times of the late 70s and early 80s.
Right. And from what I saw, he kind of connects that to more contemporary inflation concerns. So he tries to draw these parallels and see, are the lessons from back then applicable today?
So I want to start with just that period, the late 70s, early 80s. Why is he focusing so much on that? I think if you remember back then, I mean, that was a really tough time for a lot of businesses.
Okay.
I mean, inflation was...
It was just a rough time for everybody. Right?
It was rough for everybody,
yeah.
But he doesn't just say, oh, inflation was bad. He digs into the specifics, how companies were just having a real hard time figuring out, how to price their products, how to manage their inventory. Yeah, he talks a lot about how businesses had to change their strategies.
Yeah.
And he contrasts that with, obviously with how Warren Buffett was able to not just survive, but actually do pretty well.
Yeah, that's interesting.
And then, of course, you can't talk about that period without talking about Paul Volcker.
Right, the Fed chairman.
The Fed chairman, right, who came in and tried to really get things under control.
I mean, they were pretty controversial, right?
Yeah, they were definitely controversial. I mean, they did help curb inflation in the long run,
right? But
they also led to a recession.
Yeah, that's a tough trade-off.
It is a trade-off, and Labitan explores that in detail.
Yeah.
The ripple effects of those decisions throughout the economy.
And all this is tied back to Buffett somehow.
Yes, absolutely.
Yeah.
So he uses all this historical context as a lens to look at how Buffett and his partner Charlie Munger made investment decisions. I'm sure you've heard of their famous 4 filters framework.
Yeah, I've heard that phrase, but I don't know if I could explain it.
Well, basically it boils down to, really understanding the business you're investing in, making sure it has favorable long-term economics.
Right.
Looking for competent and honest management, and of course, finding a sensible price.
Right.
And what Labitan does is he shows how these principles are still relevant.
Okay.
Even in today's market.
Yeah, sometimes it's hard to connect those classic investing principles to what's happening today.
Right. It can feel a little abstract.
Yeah.
But Labitan grounds it in real world examples.
That's interesting. Okay.
And he's also a big proponent of what's called value investing, which is really all about finding those undervalued companies that have strong fundamentals.
Which is what Buffett's known for.
Exactly.
Yeah. Now, I noticed that he's written a bunch about business valuation and investment.
Oh, yeah. He's prolific.
Yeah.
His work goes beyond just analyzing Buffett. He's really developed his own perspectives and methods for evaluating businesses and navigating the ups and downs of the financial markets.
So just to kind of recap, we've got Bud Labitan. He's an author who really digs into the impact of inflation on businesses. He analyzes Warren Buffett's investing approach, and he's a real advocate for those core principles of value investing.
That's a great summary. And I think the takeaway for me is how he encourages us to learn from the past.
Yeah.
Particularly from those challenging economic times.
Right.
Because those lessons can help us make better investment decisions in the present.
And today we're diving deep into Warren Buffett's thoughts on inflation.
Oh, this will be good.
Yeah, particularly from his letters to Berkshire Hathaway shareholders between 1977 and 1983. So we've got excerpts ready to go. We're doing a deep dive into the work of Bud Labitan. And I think our mission here is to extract those golden nuggets of wisdom, kind of like a shortcut to understanding how Buffett saw inflation impacting businesses, investors, and even just everyday decisions.
And I think what we want to zero in on is how those insights are relevant even decades later.
Absolutely. So let's rewind all the way back to 1977.
Okay.
What really struck me was Buffett's discussion of this thing called social inflation.
Oh, yeah.
He was seeing how courts and juries were expanding what insurance covered. And this was pushing costs up, at that time by 1% per month.
Wow.
Now, remember, this is a pre-internet world.
That's a huge point. I mean, information moves so much slower back then. So making accurate predictions, especially around inflation, it was even harder.
Yeah.
And so what Buffett's highlighting here is how inflation changes behavior. It's not just about prices.
Okay.
It's about the uncertainty it creates.
Right.
And that impacts, things like contracts, long-term agreements.
Oh, it makes you think about contracts you might be in today.
Exactly.
Like, are they truly inflation-proof?
Yeah.
Buffett was already wary of fixed prices back then.
Well, yeah, I mean, this early concern of his really foreshadows his preference for businesses.
Okay.
With pricing power, that ability to increase prices without losing customers.
Right.
Which in an inflationary environment is a powerful advantage.
Yeah, absolutely. And then fast forward just a couple of years to 1979.
Okay.
Inflation is hitting double digits at this point.
Yeah.
And Buffett introduces this idea of an investor's misery index.
The investor's misery index.
Yeah, have you heard of this?
Oh, yeah, absolutely. So this is where he basically adds the inflation rate to the taxes that you pay on your investment gains.
Okay.
And it really demonstrates how inflation can create the situation where even when your investments are showing positive returns, you could still be losing purchasing power.
So even if your investments are doing well on paper, you might actually be falling behind.
Exactly.
Because of inflation.
Exactly. And this is where the importance of understanding real versus reported earnings comes into play.
Okay.
Because reported earnings, they're based on accounting rules.
Right.
And they may not reflect the actual purchasing power of those earnings in an inflationary environment.
Yeah, it's like thinking you're getting ahead.
Uh-huh.
But the finish line keeps moving farther away.
That's a great analogy.
Yeah.
And this is a recurring theme in Buffett's letters from this period.
Okay.
He's constantly emphasizing the need to look beyond those surface level numbers and really understand the true economic impact of inflation. So we have to dig deeper to see what's really going on.
Absolutely. All right. So we're starting to see how inflation makes it harder to assess true value.
For sure.
For both businesses and investors.
Yeah.
For both businesses and investors. And in 1980, Buffett gets even deeper into this.
Yeah.
He starts talking about how conventional accounting can obscure the real impact of inflation.
Right. He's pointing out this crucial flaw in traditional accounting.
Okay.
It often relies on historical costs, which don't reflect the changing value of money during inflation.
So a company might look profitable on paper.
Exactly.
But those profits could be an illusion if they're not keeping pace with inflation.
Precisely. They might be losing purchasing power even while reporting accounting gains.
Wow.
And Buffett argues that in an environment like that, much corporate investment becomes unwise because it fails to generate a positive real return.
Okay.
And so he introduces this concept of a hurdle rate. And this hurdle rate is the return on equity a company needs just to produce a positive return for its owners.
Okay.
After factoring in inflation and taxes.
So it's like inflation sets a higher bar for success.
Exactly.
Yeah.
And Buffett emphasizes that this hurdle rate was increasing rapidly.
Okay.
Due to inflation.
Gotcha.
And so even companies earning seemingly decent returns might struggle to create real value for shareholders.
Right.
And he paints this really vivid picture of the struggle.
Okay.
When he says the average tax-paying investor is now running up a down escalator.
Oh, wow.
Whose pace has accelerated to the point where his upward progress is nil.
Yeah, that image really captures the feeling of working hard but getting nowhere.
Absolutely.
Yeah, Buffett was seeing this play out in the broader economy.
Yeah.
But he was also applying these insights to his own investment decisions.
Right.
At Berkshire Hathaway.
Right. He makes it clear that he's looking for businesses that can generate cash.
Okay.
Not those constantly needing more capital just to keep up with inflation.
Right.
And this focus on cash flow and financial strength becomes a defining characteristic of his investment philosophy.
So he's not chasing after companies that look good on the surface.
No.
He's digging deeper to find those built to withstand inflationary pressures.
He's looking under the hood.
Yeah. In his 1981 letter, Buffett continues this line of thinking.
Okay.
And he compares inflation to a gigantic corporate tapeworm.
Oh, that's a powerful analogy.
It is.
So what he's saying is that even if a company is reporting profits, those profits could be illusory if they're being entirely eaten up.
Yeah.
By the need to reinvest just to maintain the same level of business activity in an inflationary environment.
Right.
Essentially, there's nothing left for growth or distribution to shareholders.
So this corporate tapeworm highlights the importance of understanding the underlying economics of a business.
Absolutely.
You need to see beyond the accounting numbers and assess how a company's earnings are truly affected by inflation. Does it have the pricing power to overcome these challenges? Is it operationally efficient?
Right. These are the questions Buffett is grappling with.
Yeah?
And he's not just talking about the impact on companies.
Okay.
He's also concerned about how inflation affects the insurance industry.
Because insurance companies often operate with fixed-price contracts,
Yeah.
which become problematic when inflation takes hold.
Exactly. If an insurance company sells a policy today at a fixed price,
right,
but the cost of claims rises significantly.
Yeah.
Due to inflation over the life of that policy, they can end up losing money.
It's a mismatch that can squeeze profitability. And Buffett was seeing something else at play as well, something he called social inflation.
Social inflation, right. So he observed this trend where courts and juries were expanding the scope of what was covered by insurance policies.
Interesting.
Creating more uncertainty and unpredictability for insurers.
So it's not just about rising prices,
right,
but also about how inflation can change behavior and expectations.
Absolutely.
In ways that make it hard to predict future costs.
Which makes it harder to price those insurance contracts appropriately.
Yeah, and this complexity highlights the need for a deep understanding of the underlying economics of a business.
Yes, you can't just look at top-line growth or profitability in isolation.
Right.
You need to understand how a business is positioned to navigate the headwinds of inflation.
Okay.
And how its competitive advantages might be impacted.
It's fascinating how Buffett was already connecting these dots back in the late 1970s.
Well, he's Warren Buffett.
He was seeing how inflation could create a ripple effect across the entire economy, from consumer behavior to corporate decision-making.
And what's really insightful is how he ties these observations back to the core principles of investing.
Yeah.
You know, he emphasizes the need for businesses with strong financial foundations.
Okay.
Those that can generate cash and weather the storm of rising prices.
Right.
Without being crippled by the need for external funding.
It's about finding those companies that can outpace that down escalator and actually make upward progress.
Absolutely.
Yeah, as we move into the next set of letters from 1982 and 1983.
Yeah.
We'll see how inflation began to cool down.
Right.
But new challenges emerged.
Okay.
What are you anticipating, knowing how Buffett thinks?
I'm interested to see how Buffett responded to the changing economic conditions.
Okay.
You know, did his views on inflation evolve?
Yeah.
Did he adjust his investment strategy? Right. And most importantly, what new insights can we glean from those experiences that are relevant to us today?
We left off with inflation starting to ease in the early 80s.
Right.
So I'm curious to see how Buffett reacted to this shift, you know?
It's interesting because even with inflation cooling down,
Buffett
didn't let up on emphasizing its long-term impact.
Okay.
You know, he maintained a cautious perspective, particularly regarding the insurance industry.
So he wasn't convinced that the threat of inflation was completely gone.
Right. He was still concerned about rising costs.
Okay.
And that expanding scope of liability in the insurance sector.
Right.
And,
you
know, he highlighted how these factors could continue to pressure profitability, even as broader inflation subsided.
This reminds us that inflation can impact different sectors. In unique ways, regardless of the overall economic climate.
Absolutely. You can't just look at the overall inflation rate.
Right.
You have to understand the specific pressures within each industry.
Okay.
And I think Buffett's continued focus on the insurance industry during this period also emphasizes the importance of financial strength.
Okay.
Especially in uncertain times.
So he was looking for companies that could weather any storm, financially speaking.
Exactly. The companies that emerge strongest from challenging periods are those with solid foundations.
Makes sense. Another fascinating aspect of Buffett's letters from this time is his deep dive into the concept of goodwill. And this is where he really kind of dissects the difference between accounting and economic realities.
Yeah, he seems to always be pushing for a deeper understanding of the true value of a business.
Right. And his analysis of goodwill in the appendix of his 1983 letter is a prime example.
Yes. So he distinguishes between accounting goodwill,
which
is essentially a result of acquisition accounting, and economic goodwill, which reflects the true earning power of a business beyond its tangible assets.
So counting goodwill is about the numbers. While economic goodwill is about a company's inherent ability to generate profits.
Precisely.
Gotcha. And Buffett argues that economic goodwill, unlike its accounting counterpart, tends to rise with inflation.
Exactly. And that's a key insight because it challenges the traditional view that tangible assets like real estate or commodities are the best inflation hedges.
Interesting.
Buffett's demonstrating that companies with strong brands, loyal customer bases, and other intangible assets can actually benefit from inflation as their earnings increase without requiring proportional increases in tangible investments.
So as we wrap up this deep dive into Buffett's views on inflation, what are some key takeaways for investors today?
I think one of the biggest lessons is that inflation is a complex force with far-reaching consequences. It's not just about prices going up. It's about understanding how those rising prices impact consumer behavior, business decisions, and accounting practices.
It's about looking beyond the surface level numbers. And understanding the underlying economics of the businesses we're investing in.
Another crucial takeaway is that inflation can create both challenges and opportunities. The key is to identify businesses that are well-positioned to navigate those challenges and even benefit from the opportunities.
So we need to look for companies with strong competitive advantages, pricing power, and the ability to generate cash, not just companies reporting high accounting profits.
Couldn't have said it better myself.
And finally, I think Buffett's letters remind us that investing is a long-term game.
Absolutely. It's about developing a deep understanding of the businesses we own and being patient as those businesses compound value over time.
It's about not letting short-term market fluctuations or emotions dictate our decisions.
Very true.
So taking a page from Buffett's playbook, we should be asking ourselves, are we factoring in the potential impact of inflation on our investments? And are we focusing on businesses with the resilience and adaptability to thrive in any economic environment?
Those are the questions that Warren Buffett was wrestling with back in the 1970s and 1980s. And they're just as relevant today.
Absolutely.
So keep them in mind as you navigate the complex world of investing.
Great advice. Thanks for joining me for this deep dive.
It was my pleasure.